Okay, looks like we're live. Welcome everybody to Live Valuation. I'm Midas Today we're going to be taking a look at ticker HURC, Hurco companies. Just give me a moment to double check the stream settings. And already running a little bit late today. That's okay, nothing much else to do today, luckily. I started my school semester this week, so my schedule in general has gotten very busy. And on top of that, I'm looking to make my schedule even more busy in the near future, which we'll get into. Okay, so everything looks good. As I said, we're going to be looking at Hurco companies today, but before we get into that, I kind of wanted to take a look at our watch list and markets in general. Anybody who's been paying attention to markets has probably noticed how it's been pretty volatile this week, and really just since the start of the year. Markets have taken a pretty solid dive. According to our market spreadsheet, S&P 500 is down almost 8%. Our market spreadsheet actually has a bunch of mistakes in it I need to fix, but I have made sure that at least certain cells are accurate for certain things. The S&P is down about 8% on the year, and our portfolio is pretty much just about flat. Where is it right now? Okay, we're actually down about 0.5% on the year now, so we're beating the S&P as of the moment on the year. We discussed our underperformance from last year, so we're starting to make up ground as far as that goes. But we were in positive territory for the first 3 weeks of the year, and now it's finally caught up with us and taken us into negative territory as well, but only just barely. But either way, that gives us some interesting movements in overall positions for a lot of our companies in the watch list. Some new things are starting to look more and more appealing. I did actually eventually take a bite out of Valvoline. We're slowly building that position up. It's probably not going to be a very large position, but we just did decide to take a look at that more solidly. Hovnanian Enterprises is looking more appealing. I did make some small adjustments to that valuation after our stream, however, but that combined with movements in the market as a whole have made that look actually perhaps more appealing, though that would also be small if I was to take a bite at that, but I haven't yet. So it's just interesting opportunities are starting to show up, but this next week I think will be very interesting as well. Not really most of the early part of the week. It's not really till the later part of the week that I'm particularly thinking of. I believe it's the 28th or the 29th when the first estimate of the fourth quarter GDP forecast comes in, and I'm very curious to see what that looks like. So we're going to get into Hurco companies now. I did already get into the prep work for them. They have basically no debt, really just lease liabilities, about $11 million worth at only 1.6% interest rate, which is pretty interesting, as well as only 4-year maturity, so pretty good interest rate. I wish they had a lot more debt at that interest rate, but it is only 11 million relative to their extraordinarily small market cap of 212 million. So it's a pretty tiny company we're looking at. Hurco companies makes specialized metal cutting devices and machines, like CNC cutting machines and special manufacturing devices. They sell their goods at a pretty globally distributed way, mostly in the US, or well, plurality in the US. As you can see here, 36% of their sales is from the US, 12 to 13% United Kingdom, 16% Germany, small spread of other European countries, 6% China, about 7% other Asia. So yeah, a pretty interesting spread of geographies overall that they sell these goods to. For such a tiny company, you don't usually see as much geographic diversification, so that's pretty neat. Though the vast majority of their production assets are in the United States, relative to other nations as a whole, because technically it's a slim majority of every other country, but that's every other country combined. So the vast plurality of the United States. So that's very interesting. Pretty simple segmentation. We really just gave them the machinery business category that we have from our data set, which gets an unlevered beta of 1.09, which is pretty good considering they have super low leverage. So that means that'll put them in a good position not to push this beta much higher, which would be a risk because as I was talking about recently, they have a really good sales capital ratio and a pretty decent net margin. And usually if you have good in both those categories, which is already rare enough, then you're usually given a pretty decent beta for the industry as a result, because people will be bidding up those prices. So that is cool to see. Low leverage with that type of industry puts them in a pretty decent position to possibly be a good value throughout the cycle, but we'll have to see where they stand in the cycle. I did already put the first year of data in, which tells us that their current PE is at a 31, though that is based off of the current earnings, which may or may not be reflective of the normal setup. Hard to say. It is extraordinarily different, 7 million that is, of corrected net income relative to the free cash flow to equity that which we have for them of about 28 million, and that doesn't include any debt issuance, incidentally. So, or basically no debt issuance. Because of their cash flow dynamic they have going on here. So I'm curious to see how their cash flow dynamics operate throughout a 10-year cycle. So we'll get into that now. Their website was not cooperating with me. I'm not 100% sure if that was maybe just my browser, but I didn't actually go looking too far for it. I just went and looked up a transcript from the CEO myself and read that ahead of time. So today we're not actually going to be listening to any earnings calls, which is why I kind of have just some background music, which hopefully won't get my stream copyrighted, but I don't really make any revenue anyway, so no real missed opportunity in the very short term for that. And since I'm not listening to the earnings call, well, one thing I can do is kind of give a little bit more analysis as I go, I suppose. But one benefit for having those particular streams. So we do have a negative 6 million loss in 2020. So we can already see that right now, but we'll see what that does to the overall cash flow. Because like I said, it's not really so much about the net income as much as it is about cash flow, on the assumption that the net income eventually reflects the cash flow. But they do have provision for doubtful accounts in every single cash flow statement. I've already checked that, which means we're going to include it as part of the depreciation and amortization. Let's not forget our zeros in here, otherwise that's gonna group our formula later. So here's where the interesting part was because of how large this item was. Okay, so it was a negative in this particular item, and it's a positive over here, so it's a good possibility that these things balance out over time, I suppose. We'll see how that looks overall. Still positive, but less so. either way. Software development costs are in every single cash flow line as well, so we're also going to include that. I don't like to include things that aren't specific to other investments. We're kind of going to ignore them, however. They have derivative assets and derivative liabilities, which is kind of an interesting setup where I very often will treat them slightly differently because of them being assets and liabilities. When it comes to derivative assets, they very well could be close to cash equivalents. They could be close to marketable securities. They could be close to accounts receivable, depending, or they could just be an other current asset, depending on the type of derivative they are. And since they don't really tell us, we kind of have to be vague about it. So I usually include the asset as an other current liability. On the liability side, to be safe, I usually count it as an accounts payable. So something that does need to be paid. It doesn't count as debt per se, but it is something that does need to be considered a bill, even though it also could technically follow under various subcategories in the current liabilities. It's just a personal thing I like to do. Anyway, so also with the property and plant equipment, as we were saying before, we're going to count the software development costs as part of their capital expenditures. You could count it as an intangible asset, but I'm actually just going to throw it directly into the PP&E because it's not directly labeled as an intangible asset. So that's just another personal choice. It doesn't really make a huge difference, but they do have other intangible assets. And see, it doesn't say other intangible assets, it just says intangible assets. So if it said other intangible assets right here, that would imply that the one above it would be an intangible asset, but they don't actually say that. So I'm going to call the software development costs as a real property, plant, and equipment, because they're probably thinking of the software itself as the equipment, even though they paid for the development of it. So that's personal semantics and epistemology choice, I guess you could say. We're short one. 65, 66. What did I forget? Oh, operating lease rights of use, which under some companies I might count that as property, plant, equipment as well, but in this case I'm not going to. Yeah, so we have derivative liabilities here. We're not going to count that as debt. Operating lease liabilities we will, however. Derivative liabilities for some companies I might count as debt. We are going to count it as a payable. Deposits we're not going to count as payables, which could be payables, but also might not be. See, it's like another kind of semantics thing. Payrolls and employee benefits, I count as payables, even though the benefits part usually isn't really a payable per se, but I usually count it. Accrued income taxes I count. Yeah, their financial statements aren't super simple, but they're much nicer than those last few that we've dealt with, that's for sure. 231, 295. Okay, cost of sales, SG&A. Right, 17 million in 19. It does speak reasonably better in line with the cash flow that we're sort of seeing. See what the cash flow actually looks like in this year, though. It wouldn't entirely surprise me to see it balanced off. Wait a minute. What am I doing? Leave that negative. For some companies, I would actually use the selective non-cash adjustments to put the foreign currency switch off in it. For this company, I'm actually not going to do that. If it's a company that has really large amounts of it relative to their net income, then I often choose to do that. But if not, then I just let the balance flow through. Either option's fine as long as you're consistent about it. So pretty large negative effect on this particular one, so that's interesting. And an acquisition in this particular year as well. And I'll see if the debt issuance looks a bit different. They paid down debt actually. Okay, so they have some identified goodwill in this statement that they didn't have in the previous one. That's interesting. whether that's just unidentified in the other one or that it's fully amortized by that is unclear. Doesn't really matter too much. I know lease liabilities listed here. Short-term debt listed as 0 here, then with 1 somewhere over there though. But all sorts of payables though. Oh, wait a minute. Totally did that one wrong. Projected deferred income taxes there. And the other two here. I don't know why I slapped those two together, but I did. There we go. Okay, so we're not going to take a full break, look at a whole bunch of trends while we're doing this, since I can talk in between them all, but you can see that their sales to capital ratio held up pretty strongly in 2021 versus 2019. There was a pretty huge dip in 2020, which is interesting to see. So some pretty variability in the sales to capital ratio, which is fascinating. Their shareholders' equity didn't change very dramatically during this, neither did really their debt levels. But you can see obviously their sales took a huge dip during the shutdown. So they're a little bit sensitive on that regard, but that's the benefit of having a low leverage operation, I suppose. So we can move on to year 4. Just kind of wanted to highlight that detail. And you can see over the 3-year period, if we include the negative margin that was in 2020, then the average margin comes to 2%, which it might be more like 4 or 5% if we didn't include that. That's only 3 years though, so we'll see what that looks like after a much longer trend period. $21 million in this particular year, so also pretty good, though you don't really like to see that the past was so much better than the future, but it's a little bit acceptable obviously in the post corona environment. But we'll have to make some sort of determinations about what we think about that, but it at least shows us that higher margins are have real potential for that. So yeah, 7% margin. So let's see what the cash flow looks like for that one. Provisions are back into positive territory. We do have to leave that negative effect on the provisions whenever it comes, if we're going to include it, which we had in the 2019 year. Obviously, it's this cash flow effect of working capital that's really seems to be the real changeover. Uh-oh, I didn't realize that we had this little issue right here. Hold on a second. I might need to go figure out what this number was in the file. It looks like it copied over. incorrectly. Here's this 2018. Let's hope that I pulled up on the right file. I can find this and fix it real quick. Because that's like, if it was a small item, I wouldn't care, but this is one of those ones that has a big effect. So we really want to make sure this is correct. Statements of cash flow. Okay, there we go. Enable editing. Yeah, whatever. Oh. The original file is actually not giving me anything different. Oh, there we go. Okay, never mind. I switched over into general format and it switched to that. -20. Yeah, see, that would have had a pretty big effect. So good that we added that in there. Just gotta make sure. Usually I notice these things ahead of time. It looks like I have another one over here. Hold on. Let me double check these things before I go any further. Oh man, this one's whoa. I must have been tired last night when I was doing this. So we really gotta check this one. Man. Hold on. Luckily I have this stuff open now, so I know how to fix it, but it's a pain. Okay, so we need 2014. The one I just had open was 2019, 2018, and 2017. This is 14. Jeez, okay, no, I need 16 and 14. (17, 16, and 15). So this should be 17, 16, and 15. I don't know, I'm totally getting this all screwed up in my head. Let's just open them all. (16) copy, paste. All right, so now we need 2014. Nothing like doing some spreadsheet surgery in the middle of the stream. Okay. 2014. Enable editing. General format. 2014. We'll check here. Boom. Okay, now this one, 2013, where there's like a whole bunch of stuff screwed up. Just have to, I guess, copy over the whole row. Which luckily I have right here next to me as well still, so. That one I didn't have to pull up in a different sheet for, which is cool. Okay, it's general format. Copy. It goes in below the, oh shit, missing one. Okay, I'm missing one right here. Interesting. That number is not faded out on this other sheet, but okay, so where I copied is below the 4661. So it's here. There we go. Okay, but then there is this one right here still, which is there. Okay. Jesus. Okay, well, sometimes you have to make sure that the spreadsheet is put together well. You know, they build the file gets uploaded, the file gets shifted around in the database, other people download it several times, all sorts of little random errors and misalignments between people's systems can occur. So that's just part of the game. Anyway, so where were we? CapEx for 2018. And we'll double check on the other line, I suppose, too. Yep, there. So this sum of this. There we go. Okay. So now moving on to the debt issuance, which we have some options and taxes, but still nothing else really other than that. Oh, we did have short-term debt on this one. I accidentally skipped that. Okay. On to 2017. All right, so in this pre-pandemic period, you're starting to see a lot more of a consistent, solid EPS. Not much growth, but at least a solid profitability. All right, so in over a 5-year period, we have total free cash flow to equity of $46 million, which, you know, isn't a crazy amount, but it's unencumbered by debt issuances. In fact, there's debt repayment, if anything, and they're only $2 million worth or so. So $44 million worth of pure operating cash flow is what we have here, which is pretty neat. Obviously, they're not really paying out a huge amount of it. The total amount that they've paid out to their shareholders has only been $19 million. So not even half of it is being paid out to shareholders, which is always good. They are holding on to cash and reinvesting, or protecting themselves against downturns, which obviously they have a large amount of volatility in their revenues. So we'll get to that when we're making some sort of projections. We'll move on to the cash equivalents. Like I said, I'm kind of gonna do analysis as I go on this one. Okay. I do like that despite all this volatility, we can see at least a consistent growing in retained earnings. The shareholders' equity is a little more less solid on the growth, but also a little uncertain. But we'll see if that trend continues over the 10-year period. But so far, it's holding up pretty strong in that category. Sales to capital also holding up pretty strong as far as all that goes. So as we go further back, the state of the business looks pretty reasonably solid. The margin obviously isn't a very strong margin, but at least it's solidly profitable when you're looking back far enough beyond the COVID-19 pandemic. Obviously volatile though, so just seems to be the nature of their business. Definitely have a feeling that orders for new CNC machines is probably one of the first things to go when economic downturns come. So it's easy to see how they would be a very volatile business regardless. dividends on 2017. Just, missed that one. Wait a minute. Wait about a minute. Hold on just a second. It looks like I'm screwing things up over here, so 2019 should have had okay, so actually 2019 shouldn't have had anything. Okay, so that part was right, and then 2018 did have the negative exercising of the cash of the options, and then it did have its dividends. Okay, sure that it wasn't screwing up other places as well. See one screw up and I get skeptical of other screw ups. Okay, so then we move on to the next year, 2017. Double check. Negative out the options. $2016, no options to negative out. Okay, we're good. Nike hush. All right, now on to 2015. Oh, and I'm missing the X here. What the hell? What did I do there? Five, 9, 3, 5, 6, 1. Okay. Not sure what happened. I might have clicked X on it at one point. big acquisition in 2015. I'm missing something over here. 246, I have 241. Oh, Mikey, hush. What did I screw up? What did I screw up? 218 is the current assets, so that appears to be right. Property, plant, equipment is this, plus this, minus that. Oh, somehow this is a negative. That's probably why. I don't know why. Like, okay. Short-term debt. Accounts payable plus derivative liabilities, other expenses, and warranties. Okay, still looking pretty strong. Moving on to 2014. Stretch my neck so it's not dying. Years to go. Then we can do some analysis. I was sort of hoping that I would go a little bit faster today. Wasn't really going that much faster today, and then I still had to do the spreadsheet surgery a little bit. So, well, whatever. Like I said, no real hurry today. I just have a bunch of things I want to get done this weekend. But it is what it is. With school started again, I just feel way more pressured time-wise because I have so much schoolwork to do, and then so many non-school projects that I'm involved in. So okay, which I'll get into some of that at the end of the stream. Once I'm done with the valuation, I do plan to go over I guess you could say, my stream schedule, which normally I don't really have much of a schedule per se at all. But I kind of vaguely put one together for the next couple months just because it's a little bit easier to do since earnings season's coming through. Not just earnings season, but most companies Q4 earnings. So, come on, Mickey. Come on. Come on. Move if you're gonna move. Yeah, so anyway, with the Q4 earnings coming through, that means, like, for example, all the companies in my portfolio, their 10Ks are coming through. I'm going to want to update those valuations, as well as other major companies that I pay attention to, the FANG stocks, as well as other mega caps. So a lot of those are going to come through very rapid fire, and I want to cover a bunch of them, but I also don't want to be bogged down on them forever. So I'm going to attempt to actually accelerate my streaming schedule a bit, temporarily, just for like a month and a half. I'll go back to 3 streams a week, I think is the plan, just to make sure I can pump those out as quickly as possible so that we can get back to evaluating new companies as quickly as possible as well. But I did throw a couple of new companies into the list as well, some of the ones that have been requested by a few people that I thought were actually of interest, but I just kind of wanted to wait for. But we'll get into that again, like I said, at the end of the stream. It's like I said, I came up with a whole schedule, although it's only a tentative schedule. We'll be willing to shift things around depending, and it also depends on when 10Ks get released and stuff, which some companies are very specific on when these things are going to happen, and other companies it kind of depends on a few days or whatever, and people just have their best guess of when something's going to happen. So I put together a little schedule based off of the information I was able to glean with a quick look on all the companies in question that I had interest in. So we'll cover that. I actually meant to cover it at the beginning of the stream, but after covering the watch list a little bit, I kind of immediately moved off of it and onto this, so that's fine. Cover it at the end. That works, considering I usually try to end the stream talking about what I may or may not do next, even though most of the time I don't know what I'm going to do next. So it works. This time I do, sort of. Mikey, quit meowing so loud right into my ear and the entire microphone. My big codependent cat. Okay, so that's 8 years. Sort of hope to maybe be done with all 10 by this point. So like I said, we're not going quite as fast as I hope, but it could be worse. See how quickly I can blaze through these last 2. Selling general administration, interest income, Interest expenses. Investment income plus investment from equity investees minus other expenses. Provision for taxes. Alright, on to the cash flow. Provision for double accounts, depreciation, amortization. Leave another 0 in. Sum and change of working capital. Net out purchase of equipment with software development and sales of equipment. The lines are seemingly offset from each other. I'm noticing. Try to see, this is the dividends paid. Hope it's not like that for the. Okay, cool. It isn't. I was gonna say I'm gonna have to fix it if it's for that for the balance sheet, so I can kind of look at it diagonally for the cash flow statement if I have to. But I wasn't gonna be able to do that for this. Short-term debt, payables plus derivative liabilities, accrued expenses plus warranties, deferred taxes. What happened in 2018? Was there no deferred taxes in 2018? Doesn't seem right. I feel like I remember deferred taxes in like in every year. Yeah, what the hell? 315. Whoa. Oh, that's the assets. Oh, okay, no, never mind. Just being extra paranoid because I know I make mistakes. Always be willing to look at something that looks off. Okay, anyway, 2013. Did deferred income taxes accrued liability plus credits. Common stock. Additional paid in capital, retained earnings. Accumulated other. Okay. One more year to go. 103, not too bad. Could be worse. Oh, wait a minute. Oh, never mind. Oh, I'm sorry, baby. I didn't mean to disturb you. Just relax, baby. Okay, almost done. Sum of net change marking capital is going to be here. Wait. How am I doing? Oh, what am I doing? What am I doing? Okay, there's the last cash flow statement. Now the last balance sheet. And we can do some analysis and talk about our schedule. Okay, and here we are. Hour and 7 minutes, not too bad. So okay, we'll start at the bottom. The sales to capital ratio. So the sales to capital ratio prior to 2020 was pretty stable. We have, let's see, the lowest of 144 in 2019 itself, with the highest expressing at 2018 of 204. But you know, pretty consistent band overall. The average is 1.76. The average across the entire time frame, including that, is 1.65. The average of the most recent 3 years is 1.26. So obviously that's probably way too low. Last 5 years comes to 1.52 and 9 to 1.65, as we were just saying. So I think it's pretty fair to leave the 9-year average in and then probably just project closely to that on most consistent bases. Pay no attention to that. We'll get into some of that stuff in a bit. I just kind of wanted to look at this, but we'll kind of think about that as our baseline. If you look about their overall valuation, they've generally traded in the teens in most of the area, low and high teens. So right now the trading in the 30s is pretty rough, but again, that's also projected on the fact that they, in the most recent year, they only had about $7 million in income, which their average net income over the 10-year period is actually 12 million. So it is significantly lower than the average and significantly lower than even what it was in 2019. 5-year average 11 million. So you can see, which also goes to show that you can see that their EPS was in fact growing. It's growing not super quickly, but it is in fact generally growing over a pretty consistent time period. And so it is pretty depressed at the moment. And their margins we were talking about is not, excuse me, it's not very impressive. 3-year average comes to like 2%, and then the 5-year average comes to closer to 4%. 9-year average might be 4.5 or so, 5. Yeah. So that kind of gives you a baseline of what you could expect for a long-term perspective of them. Obviously, they might be being valued on some of these margins that we're having right before, which is a little bit higher than that. But I do think perhaps this 9-year average is pretty good to go with. In fact, maybe 5-year average projecting towards the 9-year average, I think is probably a pretty fair set of assumptions to have. And then sort of moving up the line, you can see that, as we said, they never really had too much debt over the entire time period, as well as a pretty reasonable overall taxation rate. It's pretty consistent, stay in this 25% range. We can probably assume it's going to stay in that range. So the 5-year average. 9-year average might be a little bit lower than that, actually higher than that. Interesting. 9-year average will probably also be higher than that, but we can go ahead and use the, I think the 3-year average is a fair enough assumption to have. They did have a loss most recently. The 3-year average of the rolling debt issuance comes out to actually 3 to 4%. I think that's not super representative of their overall debt profile, which shows them only having 2% right now. However, if they're issuing more debt, I think it's unlikely that their business model will be able to get that super great rate anyway. So using a 3% to 4% rate probably makes more sense. It's not going to make a huge difference because of how low their debt is on the average overall. So if you look at their revenues, you can see the revenues have definitely moved up at a pretty bumpy rate, with lots of dips and dives and large spurts and overall. But over a 5-year rolling period with 5 years of that, you can see that it's mostly stayed in pretty positive territory, with only in 2020 with a huge 35% dip in revenues that it actually reached a negative 5% CAGR over a 5-year period, which quickly bounced up to flat territory in 2021. So you can assume that perhaps it comes back to this like maybe 3% range, which seems to at least be somewhat of a sticky point after you, for example, average in some of these numbers overall. It does sort of look like that the average comes to 2 to 3% or something. So I think it's fair to assume that we might reach back to 3% or something like that. But anyway, we'll see what we come up with when we look at all these things. Like I said, don't get attached to the valuation at the top. Let's go down the line and kind of like look at our cost of equity and weighted average cost of capital. So yeah, 4 to 5% debt to equity ratio, pretty tiny and measly. If we assume that the market cap takes a pretty significant dive, perhaps to 100 million or so, while also they issue a pretty significant large amount of debt, that would still bring their debt to equity ratio pretty small. You can assume maybe up to 25% is a pretty significant jump for them in general. We'll leave a 0% on there, and then we'll probably have to tilt things a little bit further. We'll also maybe even shift that lower. So maybe assume 10% for this, which would put that in that range. Where does that leave the distributed value? Distributed value comes to about 12%, so it's still a little bit high. Maybe we'll leave this actually just at the 5% where it currently is, and then perhaps shift this to 20, which puts our expected value to 9%. That's a little bit more reasonable considering where they're currently at, but we'll see how we adjust that after dealing with probabilities. The fact that they have basically no debt means their weighted average cost of capital is pretty damn close to their cost of equity, which, like I said, they don't have a huge amount of debt, so their levered beta doesn't jump up too dramatically, which is good for them and their valuation as a whole. So let's see, moving up to returns on invested capital, probably going to be a little bit rough. We were looking at longer range time periods for most of their measures, which we'll probably have to do for this as well. Jumps up to 7% if we do the 5-year range. If we do a 9-year range, it jumps up to 9%. So I think that a longer term range does make sense. Like we were saying, we're going to be using 5 to 9 year ranges for a lot of our estimates and thought processes. So we can use probably 5-year here while thinking about the 9-year in terms of where we're headed. Speaking of which, we can kind of look up here where it is. It's currently projected to 13%, but that is on the back of really high margins, so let's adjust that. With the fact that they do have a pretty chaotic business setup, we do have to project in, I think, a negative margin as a worst case scenario. There are some arguments to be made against not doing that, just on the basis of how good their overall balance sheet setup is. So the likelihood that they would actually have a negative margin perpetually is unlikely, but I would also argue that if they can lose 35% of the revenues in 1 year due to a global economic downturn, then a sustained global economic downturn actually possibly could put them out of business regardless of that. So I think that regardless of their good balance sheet, we would still have to measure in the possibility that a negative margin sustainably is an option for them, if not extraordinarily low, at minimum, which 0 doesn't usually work with my formula, but we'll see if it does work today. It does seem to work, but it has to do with some of the cash flow dynamics. Anyway, top level of the margin definitely can't be 15%. The best year that they've actually had on our 10-year record comes in under 8%. So I mean, if we just, for example, stop at maybe 8% there, we can see where that leaves us. With a midpoint about 4%, I was saying that I can easily see 4 to 5% due to the long-term average hovering in around that range. It kind of made me actually want to put essentially my expected value in there, so we can maybe put this range in here and then tilt it slightly more towards the optimistic end of things. And then it comes down to revenues, which we do want to leave some strong variability in. As you can see, they do have some strong variability in the potentials for the revenues, but I do think this current range is not actually terrible if we were to adjust some probabilities. Like I said, I was sort of assuming a return to perhaps this this sort of range in here of 3 to 4% as an expected level. So if we were to simply adjust the probabilities around, then I could actually see this as a pretty viable option. Maybe we take 10% out of there and shift it more into the probable end of things. That brings expected revenue CAGR to 3 to 4%. It brings the expected net margin to 4.5%. Returns on invested capital are down to 6%. That shifts. Oh, well, we didn't actually do a super good guess on this, did we? We didn't run into doing the adjustments on this. So if we wanted to make it move towards 165 approximately or so, then we could assume maybe a worst case scenario in the range of where they were for 2020, which shows what happens to the sales to capital ratio under a global pandemic environment. So we'll maybe use 0.75 as the worst case scenario for them. And then we would have to push the best case scenario up pretty dramatically. 2025 would be above their best case time frame that they've had in our 10-year period, which means the expected value to 148. Although we do need to adjust this one, so we put that more on the optimistic end of things. That brings the expected value to 159. We could shift this up a little bit higher. I do think it tends to tilt more towards the optimistic end of things as far as sales to capital ratio goes. That does dramatically improve their valuation as far as what we were looking at prior to this adjustment. So that, let's see, that leaves the expected value at 171, which is maybe being a little generous to them, but I don't know. At the same time, it's not very over generous, I think. Let's see. think. Any other ways in which I want to adjust this? I kind of want to push the revenues up a little bit higher, but I don't really want to push the top range any higher than 10%. In fact, I almost want to push it lower than this, but at the same time I want the expected value up. So it's like I would have to lower this to 9 while maybe shifting this to -3 or something. But I don't know. Let me just shift this to -3 and see how that brings it to 4.21%. Which is maybe optimistic. We just leave it here and then maybe actually adjust the probability a little bit further. We'll see where that leaves everything. 3.63. Leaves the expected margin 4.5%. And the expected return on capital is 7.81%, which is pretty close to sort of the range we were expecting. Let's see. I think I'm pretty happy with these sets of assumptions. The only thing left to adjust primarily is the default rates, which for this company is going to be extraordinarily low. So we'll see about that. 8.25%. Let's maybe assume this pushes up to 25. The help or hurt them? It barely moves them at all. Because the expected debt levels are implied by that don't really make a lot of sense, but that's because of some of the other assumptions that go into the equations. But that should affect a few other things. Okay, and that pushed the expected value to 10%. That's not too bad. Okay, I'm okay with these sets of assumptions, but let me adjust. Let me think. So we'll assume that they can pay off the debt in the best 3 sets of cases. Well, 4 actually. Yeah, so it's basically no default risk. Some major default risk in one of the cases, but on the net that keeps it really low. Okay, so that's gonna do it for that one, I think. So ticker HURC, Hurco companies, CNC machinery manufacturer. They manufacture the machines themselves anyway. U.S. Treasury today is 1.771%. Mature market equity risk premium, I get 4.66% currently. I come to a discount rate after adjusting for company-specific idiosyncratic risk of 7.63%. The company currently has a discount or a dividend rate of 1.82%. 5 years ago, they had sales of $227 million, and they currently, in the most recent year, had sales of $235 million, which gives them sales growth of 0.69%, relatively flat over the last 5 years. The sales to capital ratio is 1.65% over a 9-year period, relative to industrial expectations of 2.04. They have returns on invested capital of 7.117% over, I believe that was the 5-year period. It was either 5-year or 9-year period. And they have a debt to equity ratio currently of 4.5% or so. The default risk is pretty much 0. That's actually supposed to be the current year default risk, which actually would have been 0. But my bad, I forgot that part. So they have no default risk in the most recent year because they basically have no debt. Profit margins over a 5 or 9 year period, I can't remember which one it was, it comes to about 3.84%. We use that because they have some volatility in their earnings. Industrial expectations for them would be 13.36%, so they're a bit low on the profit margins area, though they do hold up pretty strong in the sales to capital ratio, though still technically lower than their industrial expectations in that category, which is fine, I suppose. But they are getting a similar discount rate as what would be expected based off of those metrics, so unfortunately they're being punished for that regardless. But they do have volatile earnings, so I guess that's deserved. $7 million in the most recent year is their profit, and against that, their current selling price for the share is $30.80. The probability distribution that we use for them is pretty heavily tilted toward the optimistic ends of the third and fourth model. Based on that, we come up with revenue projections of anywhere from 182 million to 379 million as the best case scenario, with an expected value of 284 million. Which gets us revenue growth assumptions of -5% in the worst case to possibly 10% in the best case, with 3.63% as an expected value. The sales to capital ratio that we come up with for them is 1.73 for the 5-year forward period, with a return on invested capital expected value of 7.81%. Their debt to equity ratio we also assume will possibly push up to around 10%, either through equity value dropping or through issuance of new debt. Default risk on this debt we do presume to be basically 0 on an expected basis. It's less than 1%, close to 1.5% per year for the next 5 years chance of default, so pretty negligible. We do have profit margin assumptions in the 5-year forward period of 4.55% on an expected basis, which gets us a profit assumption of around 14 million. And based off the discount rate that we have for the company, that gets us a present value expected price of $26.57, which is 13% to 14% lower than the current share price. We have 5-year forward value targets, unadjusted for dividends paid out during the period, of anywhere from $7.86 per share in the worst case scenario to possibly $84.77 per share in the best case scenario. On an expected basis, we assume a value of about $38.38. So based off of that and the current price that's selling at, we get an applied return for the next 5 years of 4.5 to 4.53% per year for the next 5 years. So not a very good return, overvalued a bit. The valuation score we come up for them is 0.47 because they do have relatively low margins as well, so not very impressive overall on multiple linings. The pricing metrics that we come up with for them is a little screwy because we don't actually have an analyst based projection number, so it's going to actually put in the earnings prediction number that I currently have. But based off of the market multiples they're trading at, we actually would expect them to trade at a very high price, which could explain part of the reason that they're overvalued right now. But that pricing value is obviously much higher than the current price, but I think that has to do with the way that the industrial industry as a whole is pretty heavily discounted as far as multiples go. So you see some pretty low multiples for them in this category as a whole. So that's going to do it for Hurco companies today. As I said, we will cover a little bit of something else, the plans I have as far as the stream schedule for the next month or so, depending on factors. Like I said, this schedule is not a permanent fixture or anything, or any sort of guarantee or whatever. It's just kind of me thinking about the companies that I know are going to report nearby and soon, and I just kind of put in dates that I found. It wasn't like an in-depth search, so some of these dates could be off. Don't yell at me or get upset or whatever. Don't rely on it. I just kind of based earnings dates off of what either Yahoo said or the company's website said, and the last 10K date, which is literally the date that the last 10K was released, as my assumptions to kind of like know when to look for these companies. And so these are roughly in order of when I plan to value them moving forward, as they release, based off of this ordering of the date, assuming it's accurate, because I need the 10K, not just the earnings. But we'll pay attention to the earnings to see what happens. So Intel should hopefully be coming out with their 10K soon. We do own Intel, so we want to cover them as soon as possible when their stuff comes out. Facebook and Netflix should also be coming out in the near future. They're part of the kind of FANG stock large mega cap group of companies that I typically like to pay attention to whenever they release information, just to have an opinion on some of the big companies, you know. So I'll be valuing those. Biogen, the next one on the list, is also one of my companies, so I will be valuing them as well. Mikey, make up your mind. It's like, make up your mind or move, buddy. All right, so Biogen will also be covering because it's one of the companies in my portfolio, so I need to cover that as soon as possible. Followed by Amazon and Google and Tesla, all of which are also big mega cap companies that I like to value whenever their information comes out. Followed by INMD. That is one that's been suggested multiple times now in our chats, and I did take a look at it, and it does look like a pretty interesting company. However, I didn't want to value it 2 to 3 weeks ahead of them releasing their 10K. That seemed a little silly, so I decided I would just wait. But that should be coming out at some point here soon, so I'll probably cover them when that does happen. GTX also in my portfolio, so we'll be covering that one when it comes out. NRDY used to be in my portfolio, but I know some people personally who are very attached to this company, and so partially for their own requested reasons, I will be paying attention to it and valuing it just so that they have some people that I know can have an accurate valuation for their own purposes, regardless of my own lack of interest in it at this time. PPL, T, and AbbVie are all companies in my portfolio, so we'll be valuing them on that basis, though I had been selling some ABBV in the most recent future because of the elevated heights it was at, but it's still in the portfolio, and we stopped selling it for the time being as it pulled back a little bit and we readjusted some things, but we should be getting that 10K soon anyway. And then T, I have been trimming as well, mostly just because my position was too large in it for a while, so I needed to adjust that. But either way, I am holding that, trying to continue to hold that through the merger, so we'll be valuing that as well, along with PPL, which has been a holding we've had for a long while, and it's just been there, so we'll be valuing that as well. Followed as well with DGX, which has also been recommended by a viewer of the channel that also looked pretty appealing, but same with INMD, it did not have its most recent information out, and it was going to be reporting recently soon, so it seemed silly to get ahead of myself on that one, so we'll be valuing that whenever it does release its 10K. And then Discovery, that one I'm not super interested in on its own, but that is part of the merger with the Warner Brothers Discovery and AT&T. So as part of being a shareholder of AT&T, I will be valuing that alongside AT&T and then reevaluating my pro forma merger valuation for that. So this is the tentative schedule for the next month and some change or whatever for the stream schedule. Like I said, I plan to stream 2 to 3 times a week, depending on what's happening and how many of these are available. And I might slide one in or there, and like I said, the order could possibly shift around a little bit, but this is based off of when they release the 10K. So if companies release their 10K, that moves them up in the order. The third stream I plan to do, I currently have the one on Monday and Friday. If I'm going to be adding a third stream on any given week to cover extra companies, I think it's probably going to be on Saturday. I think that's what I'm planning to do, but so it just depends on all those factors, and we'll see what happens with that. But I'm not currently certain of what we're gonna do next and on what date. Like I said, Monday is typically what we might do next, and until maybe they'll release it over the weekend. I don't think they've already released it, and I don't think that's going to happen necessarily. So I might actually have to slide one other company or another 2 in before this schedule actually fully kicks off. But I did want to at least mention this, like while the earnings season is in swing, I will have some pretty high demand for things. So that's going to do it for us today. If you enjoy high in-depth financial analysis like this, please subscribe to the channel.